to be at a premium in this current price range here, and that's assuming none of the price action from this high down all the way to the right has not happened yet. So you'd be watching price in this initial range, and price did not get back up to the midway point, or 50% of the range that was created from the high to the low. That's all equilibrium is 50% on the fib. That's how I'm describing it. But the concept is you have to see a market price a move above the halfway point. Once it does that, it starts going into what is referred to as a premium market. That means it's at a really high price relative to its current trading range. We don't need overbought and oversold indicators to help us classify an overbought or oversold market. We just simply need to know the current price range we're trading in. And if we get above the 50% level, okay, we start getting into what would be deemed as overbought or at a premium level. On this price swing here, it obviously never gets above the 50%, never even touches it. So it never gives us an opportunity to get short relative to this time frame or this price swing. So there would be nothing to do there. The next price leg here, okay, the same thing from this high to this low. Nothing in terms of that price swing there. It doesn't get back up to the 50% level. But look closer. There's another smaller price swing that has formed right in here. Okay, so we could look at that, measure the high to the low, and the market gets right to a equilibrium, but does not stay above to go to a premium market. It only goes right to the Fibonacci 50 level, or what we deem as equilibrium. So price goes to an equilibrium price point and then immediately sells off. This would be a missed opportunity in regards of looking at equilibrium to premium. The reason why we want to focus primarily on the 62 or 79% retracement levels in that range to be selling short is because the market's going to be really pressed higher and would be really, in terms of overbought and oversold, it would be very overbought, and it would be expecting a willingness to sell softer and go lower. There's going to be times when the market does not give that scenario to you, and you just got to let those particular price swings go without you. The next price swing is this high to this low. Market trades back up to equilibrium here. And move this over so you can see a little bit better. Okay, so market trades back to equilibrium, goes back above it into a premium market, and it goes right on through what would be deemed as an optimal trade entry, okay, or selling at a premium. So here's a wonderful thing about this. You can look at this and say, okay, if I'm measuring this high to this low, and I want to be selling, I'm above equilibrium, I want to get short in this area between 62 and 79% retracement level, okay? You look over here, maybe there's something over here institutionally in terms of a bearish order block or something like that you can define. We're going to say that that's not there. We're going to say that you went short just purely on price action, retracing back into this Fibonacci level here. It comes all the way up and hits you where your stop would be. When you see these conditions where the market trades above equilibrium and goes through the levels of 62 and 79% retracement levels, what that does is it gives you a condition that we saw in the equilibrium to discount. If it takes out a previous low when it's in discount, it's probably going to be a turtle soup buy. In this case, it's going to be a turtle soup sell. It's going to be reaching for stops above the impulse swings high. And you see that here. It goes up, runs out the stops here, and then it goes lower. Where is it going to go? Where do you take profits at? Below lows that's already established in the marketplace here and here. And you see that's exactly what the market does. You can also use, when you're defining your ranges, all price swings from high down to low. Okay, you want to anchor your Fibonacci on. The market goes down from this high all the way down to here, okay, and creates that low. As soon as we start seeing it bounce up,